Okay, welcome back to Ultimate Trader webinar series. This is webinar number 4, the Profit Pivot. Essentially what I want to do in this session is really walk you through all of the elements that we look for when taking a steady trending based trade. Now in the trading world there's really two types of trade we can place. A pivotal based trade, which is generally with a trend, or a breakout based trade, which is generally at any time given market conditions. In other words, breakouts are really those kind of trades where we look to take relatively short-term profit objectives in a movement. And it doesn't necessarily need to be moving in a certain trend. We can have a relatively flat market, but if a certain consolidation breaks up or down, then we can look to take that trade on. Real pivots, as we're now going to discuss here, need to have certain trending conditions. For example, either trending upwards or downwards, and then we want to make sure that we enter the price at the right time. As I discussed in earlier modules, remember, most people enter trades at the wrong time. And that's generally because they're entering trades based on instinct. Instinct will tell you to enter the trade as everything is stretching up. Notice that this particular diagram I have here, when the move starts down here, people get excited. They get warmed up here, they can't wait to buy up here, and then immediately the stock retraces. Notice where my timing is. First of all, I wait for the trend here to be established and moving. Notice this squiggly line underneath the price action, and that represents the moving average. Notice here how the price has moved up, steady with the trend, but this time it's moved down and pulled back towards the moving average. And that is something you would expect. You'd expect the price to retrace towards the moving average, but then you'd expect this to happen. You'd expect the retracement to the moving average and then a reversal bar. Now, what is a reversal bar? A reversal bar says, notice how this previous bar here, this red bar, opened here. The left-handed handle is always the opening price, and how it's closed lower. This is the right-handed handle. That's the closing price there. So because this bar closed lower than where it opened, clearly it's a down day, as it was in the previous 2 days. But notice here, this bar opens here and closes higher than the open and therefore reverses the move. That's why we call it a reversal bar. It ends the selling here and now starts the resumption of this uptrend. This really is our signal to consider placing the trade. Now there's a number of other factors that we must approximate and must estimate and measure around this trade before we think about placing it, but I want to give you the overview so you have an understanding of how we place pivot trades. Thirdly, we notice that the trend is moving in that direction, so clearly this would be a long trade and certainly not a short trade. And contrary to popular belief, if this trade did start to move up and then reversed, we would not take a short position on. And the reason we wouldn't do that is people who take short positions on markets which are moving long after they've entered long are really people who are just trying to be right. Trading is not about trying to be right, it's about making money. And therefore we've got to make sure that if the trade doesn't go against us, we simply cancel ourselves out of the move and then look for another opportunity, not trying to be right on every single opportunity that we come across. Lastly, we want to make sure that we enter the trade just as that new trend starts to pick up. So this is moving average, is moving in the direction of the trend. Our entry price or our entry for this trade would be as the next bar forms and starts to move upwards. Notice how we would then be at the correct part of the cycle. Let's go and take a look at that now on some live charts and see how this really plays out in the real world. Notice here on Rolls-Royce, here's a classic. Notice how this stock has been trending, bouncing off the 20 and then the 50 period moving average. Notice the blue line here is the 20-day moving average, the red is the 50-day moving average, and way down here is the 200 moving average. Notice here that as the price moves up, it then pulls back and bounces off this 20 period moving average. Notice the movement here of the reversal bar. I'm adding points. You can see that we have what we'll teach you throughout the program is how to use a scoring system so you know exactly how many points a certain trade is worth and only certain trades will you actually take. In other words, we're going to make this clinical. We're going to remove all the emotion out of the trade and we're going to evaluate each trade numerically. So if the trade doesn't reach a certain numerical score, we simply won't place the trade. And that is the cleanest, most accurate way of trading because it gives us a numerical score which we can rely on as opposed to gut feeling a trade which really, if we put in a matrix and were to measure, would probably only score a 3 or a 4. In this world it allows us to measure exactly how many points each trade is worth and therefore build a good strong case for placing the trade before we go start risking any capital on it. So notice here you can see certainly the stock has now reversed and it's in line with the trend, so we can see what we've added our points from here. You'll see some of the points on this chart will give you an understanding, but not complete clarification, but an understanding of there is a point system in place that we use, and then of course off the stock goes and moves. Notice that we have an uptrend which is higher highs and higher lows. That gives us an extra point, and our moving averages, notice, are moving in line with this stock. So what we can certainly see here is that that just on this one trade alone, this Rolls-Royce trade, it's a 5-pointer, and anything clear of 4 points is certainly good enough for us to place. And then the next step, of course, would be to measure all of the reward risk and of course the trade sizing before we place the trade. That which of course has been covered in other webinar modules that you're about to sit through.